Hello and welcome to this session, Learning Outcome, LO2. Understand sources of business finance and the techniques used to develop investment strategies. Today, we'll explore the key sources of finance and how to use them effectively to plan investments, manage resources, and drive business growth and sustainability. Understanding where money comes from is foundational to any financial strategy. Business finance falls into two main categories: internal and external sources. Internal sources include retained earnings, sale of assets, and working capital management. External sources encompass short-term and long-term finance options. Each source has its own benefits and limitations. Internal finance comes from within the business. Retained earnings are profits reinvested instead of distributed to shareholders. Selling unused assets can provide a one-off cash influx. Working capital management tightens cash flow control without raising new funds. These methods improve liquidity and reduce dependency on external finance. External finance involves funding from outside the business. Short-term options include overdrafts, trade credit, and short-term loans. Long-term finance options cover bank loans, venture capital, and equity finance. Government grants and crowdfunding also offer unique opportunities. Each option varies in risk, cost, and impact on ownership. Once funding is secured, it's crucial to invest wisely. Investment strategy involves assessing where money should go and what return is expected. Techniques like payback period, net present value, and internal rate of return help evaluate investments. Each technique offers different insights into potential profitability. Strategic fit and risk assessment are also vital. Portfolio management is key in investment strategy. Asset allocation distributes investments across different classes. Diversification spreads risk across sectors and geographies. Rebalancing ensures the portfolio aligns with strategic goals. These tools help manage multiple investments effectively. They align investments with financial objectives and risk tolerance. Risk assessment is crucial in financial planning. Scenario planning forecasts best, worst, and most likely financial outcomes. It prepares businesses for market changes and unexpected costs. This approach is useful in capital budgeting and strategic planning. It ensures businesses are ready for financial risks. Investment decisions should align with business strategy. For instance, investing in automation supports cost reduction strategies. Strategic fit ensures investments contribute to overall business goals. It enhances efficiency and competitiveness. Aligning investments with strategy maximizes their impact on business growth. Financial and money markets are crucial in business finance. They influence capital raising, liquidity management, and risk hedging. National and international markets offer different opportunities. They impact financial planning through interest rate and currency risk management. Understanding these markets is essential for effective financial control. Financial intermediaries connect investors and borrowers. They include banks, investment firms, and insurance companies. They provide access to capital, risk advice, and transaction support. Their role is vital in structuring loans and issuing bonds. They influence financial planning and control through their services. Stock markets facilitate buying and selling of shares. They allow firms to raise equity capital through IPOs. Corporate bond markets enable borrowing through bond issuance. These markets are essential for long-term financial planning. They reflect investor confidence and influence financial decisions. Money markets are crucial for short-term funding. Instruments like treasury bills help cover cash flow gaps. They manage currency and interest rate risks. Money markets ensure businesses meet immediate obligations. They help avoid liquidity crises and control financial exposure. Banks and institutions play a vital role in finance. They provide loans, overdrafts, and credit lines. As advisors, they assist in capital structuring and investment decisions. They influence borrowing terms and financial planning. Their role is crucial in shaping financial strategies. Financial instruments include interest-bearing and discount instruments. Loans and bonds provide predictable returns. Treasury bills offer secure short-term investments. Derivatives manage volatility in interest rates and exchange rates. These instruments aid in cash flow and budget planning. A business investment strategy is more than just profit. It balances growth, liquidity, and sustainability. Strategic planning involves financial tools, risk assessments, and performance frameworks. This structured approach supports long-term performance. It ensures investments align with business objectives. Portfolio management involves managing a collection of investments. Asset allocation diversifies risk across asset classes. Diversification spreads investments across sectors and geographies. Rebalancing adjusts the portfolio to maintain strategic goals. These practices align investments with financial objectives. Understanding risk appetite is key in investment strategy. It influences asset selection and time horizons. Risk-averse investors prefer capital preservation. Risk-tolerant investors accept volatility for higher returns. Balancing risk and return is crucial for strategic investments. Strategic management models guide investment alignment. SWOT analysis identifies strengths, weaknesses, opportunities, and threats. Pestle analysis evaluates external factors affecting investments. Porter's 5 forces assess competitive industry dynamics. These models inform strategic investment decisions. Setting clear investment objectives is critical. Objectives should be smart, specific, measurable, achievable, relevant, and time-bound. Examples include achieving a 10% ROI over 3 years. Objectives guide strategic investments and risk management. They ensure investments align with business goals. The balanced scorecard evaluates performance from 4 perspectives: financial, customer, internal processes, and learning and growth. It ensures investments are judged beyond financial returns. The scorecard helps balance short-term gains with long-term value. It supports strategic investment decisions. Modern portfolio theory helps design optimal portfolios. It argues for maximizing return for a given risk level. Diversification reduces unsystematic risk. MPT encourages data-driven investment decisions. It helps businesses understand investment trade-offs. In conclusion, we have learned that navigating business finance and investment strategies is crucial for success. Understanding financial sources and employing strategic tools supports growth and sustainability. By aligning investments with clear objectives, businesses can manage risks effectively, ensuring long-term performance and stability in a dynamic market. Moreover, effective governance transforms strategy into sustainable results, turning plans into lasting success. Navigating business finance and investment strategies is crucial for success. Understanding financial sources and strategic tools supports growth and sustainability. By aligning investments with objectives, businesses can manage risks effectively. This ensures long-term performance and stability in a dynamic market.